There has just been a major restructuring, which will save Greece about 100 billion euros a year. But if you look at where the new bonds are trading, investors are saying that this is not sustainable, that they'll have to come back for yet another restructuring. Would you agree with the market's assessment on that?
I would, because as you've been saying, effectively, there's been a 70% haircut for the bondholders, and there's a built-in further haircut in the nature of the instruments that they've taken. So it's more than 70% in reality. And yet you've still got 120% to GDP debt ratio within Greece. And therefore, to be honest, it seems hard to think that that has sorted it out for Greece. So I would agree with the market's assessment that at some stage there will need to be more therapy, if you like.
And that's 120% of GDP by 2020.
Right.
And the market's quite skeptical of that happening.
Yeah. Exactly.
Do you think then that it was wise to take the action they did to bail out Greece? Are we just, in a sense, postponing the inevitable here in terms of another default?
It's a good question. I think there's a balance here between, if you like, further stabilizing the euro ship, or facing up to something that may be inevitable. And I can absolutely understand why politicians and policymakers say that what we need is a period of stability to allow Greece really to get things rather calmer. And if further attention is required in due course, then fine. But there is a knock-on feeling of greater stability in the Eurozone that is, if you like, worth the investment in Greece for the moment.
But in a sense, what we're doing here is just buying time, aren't we?
We are, in reality. Because I think another point really, and for me the critical point is, can Greece really deliver growth for its citizens if it's in the euro? Or is that just too expensive a currency? And do they need to go back to the drachma or another currency in order to stimulate exports? That's the big question.